Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kurt Kruckemeyer, the Principal Advisor of Pebble Valley Wealth Management. We are a fee-only advisory firm helping our clients make informed decisions on the road toward financial security. You can find more information at pvwealthmgt.com. As a brief legal disclaimer, our discussions here should not be confused as financial or investment advice, and each person's situation is unique. All right, let's go. On today's show, we're going to cover episode 2 of our Finance Fundamentals series. Joining me back in today is Maura, so thanks for coming back, Maura.
Yeah, thank you for having me.
Yeah.
Yes.
It's a sad week for me. It's your last day, the last week, I should say, at Pebble
Yes.
Valley. So
Yeah, it's been a good summer.
yeah, it's been an excellent summer for me. So hopefully you learned some things. We definitely got
Yes,
a lot to learn.
learned a lot.
Excellent. So, we are back for episode 2. I appreciate you coming back again and
Yeah, I had fun.
sharing the questions, and we'll answer away. So, before we jump into episode 2, if you don't mind, just a quick recap for episode 1. So, those who haven't seen it, I highly recommend you go back and look at it. It was middle of July. We published that one. We're recording this today on August the 19th. So, I think it's the first day of school for the youngsters, and I think your former high school friends.
Yeah, they've been back since Monday.
Since Monday, wow, yeah. Do you miss it?
No.
No, that's good, yeah. Exciting times ahead. So go back and check out episode 1, just a brief summary of it. We covered 4 topics. Maura had some questions on. So one was budgeting. Second one was how you pay the bills, do a debit or credit card. Short answer for now is debit card. Savings and investment. A lot of that focus was on savings, and we'll get an investment today. And then news sources and how to keep up with, what to keep up with in the news sources. So I guess one quick thing, kind of a do-over for me on the news sources. During that episode, I had kind of mentioned that it's like, well, keep up with some local events, but don't get too caught up in the daily market swings. The one thing I would say, though, and I think, do you have access to news sources at Wisconsin?
They give us, students the Wall Street Journal login, which is really cool.
Yeah, very cool, yeah. So I'm gonna caveat my comment last time where I said, don't worry about it. Since you have access to it, definitely, look at it. It may not be every day, but, skim it, see articles that are of interest to you and read them. My mother-in-law always gave me the advice, too, is reading the opinion pieces. You may not agree with them, but you kind of hear the argument behind something
Both sides.
you hear the noise. And so, so definitely read the Wall Street Journal or more of it. So
Okay.
that would be my one advice there. But so that was a brief summary of episode 1. And we've got, this is our second and last. And so what exciting topics are on your mind for today?
To start, I was going to talk a little bit about, a diverse portfolio. Right now, I know I have a Roth account started, but other than that, the majority of my money is in savings because I'm kind of too afraid to do anything with it. So I know it's kind of harmful in the long run, but I don't really know where to begin.
Where to begin? Yep. Yeah.
Investing.
Yeah. Great question. Yeah. So the first episode, and again, I'm going to be repeating this a lot today, but things that you need for the near term, the bank is the place to go. So even if it's, aggressive investors, if it's something you need near term, bank savings are where you need to go. But yes, it's okay, where do you go, beyond the bank, right? You got your savings in your checking, the debit card. But it's okay, Kirk, this is for longer term money. How do I go beyond the bank and what to consider? I guess a few things moving beyond that, some general concepts, and I'll have some links to on our blog post that I've done some past blog posts on these concepts. One is how soon you need the money. So again, talked about near term already. Keep that safe. Retirement money is going to be long term.
Yeah.
And that's good. And then there's kind of maybe the intermediate term for maybe a new car and, a few years and stuff like that. So first and foremost, it's okay, when you're stepping beyond the bank, how soon do you think you're going to need it?
Yeah,
back?
that was definitely one of my questions, was kind of if young investors should take larger risks since we have greater time for our returns to grow.
Yep. Short answer is yes. And so yes, provided that you don't need it near term. So again, I won't beat the dead horse on the safe stuff that's in the bank. So let's say you need it for a new car, in a few years. You don't want to go too aggressive. I'd say within less than 5 years is a general rule of thumb. You don't want to, even if you're an aggressive investor, you don't have a whole lot of time because you need it in a few years. And so you could put money in the market 2008, put $100 in, it fell as low as $50, and it took about, I think it was 7 or 8 years before it got back to that 100. So near-term stuff, don't go too aggressive on the market. But the longer term, yes, you have the ability to, take on more risk because time is on your side and you don't need it right away.
So is that kind of, you have more time to
speculate
versus investing or stuff like that?
Yeah, so investing. So key, investing, yes.
Yeah.
Speculating, no. Yeah. So that's a great distinction. I know out there now they have like these prediction markets and things like that. Be careful with those. That's more speculating. With investing, no one knows what the future is going to hold. So whether it's investing or speculating, you don't know. But investing is you research what you're putting your money in, and you'll have an idea of, it's like, okay, I don't know what's going to happen, but historically speaking, I can expect this.
Yeah.
And so that's more of a longer term play. Speculation, you don't know. It's gambling. And sometimes I use options, but options can be put in depending upon how people use them. Oftentimes I'll hear stories of, hey, we're doing these really complicated option strategies. That's more of that speculation than it is investing. So, but yeah, you want to look at that. And then the other thing too, in the investing world, I mentioned, understanding it and, how it's going to behave and how your portfolio behave. So a few things there. And again, this is going deep. So I guess here's your first college assignment maybe is, for you and the other listeners too, read up on these concepts and get to know them. Is, what is putting a portfolio together? It's like, okay, I'm going beyond the bank. I'm going to invest in it. What should I do? You want to think of, you're going to invest in different called asset classes. So at a high level, think, equity, bonds, alternatives, and cash. Those are four. I break out a lot more, but let's for today stick with those four. Each of these will have different return, higher and more can fall more too. So have different long-term return expectations, and also they'll swing more. Whereas cash, lower returns, but also doesn't move much.
Yeah.
So that's why it's good for near-term money. And then bonds are in between. So kind of knowing that and what mix you put in there is how you can construct this portfolio for you.
So then what kind of risks are you taking on, and reducing, I guess, or reducing while you create a diverse portfolio?
Yeah. So definitely they always say there's no free lunch. But in investing, there's actually something is free, and that is diversification helps. Sometimes if you do it properly, you can get a similar expected return, but lower risk. Meaning, when I say risk, I'm meaning how much it moves up and down.
Okay.
You pick up your statement each month, and it's like, oh wow, it's moving around a lot. That's that one definition of risk. How much it would fall. It's called a max drawdown. Other things, but so by doing it, sometimes the equities can move up and bonds can go down, and vice versa. The yin and the yang, if you will.
Yeah.
And so putting together these four ingredients, or sometimes I do a lot more, these ingredients can move differently. And so you get a similar expected return overall from the portfolio, but because they yin and the yang, it doesn't move as much for you. So that's the benefit of having that diversified portfolio.
Okay.
So
yeah.
So that's and then again, what should you invest in? So again, you're moving beyond the bank, and so you don't just give it to them and they do something. You got to pick. Okay, you put this money in this account, and we'll talk about the accounts in a second. Like, okay, do I buy cash? Do I buy stocks, individual stocks, ETFs, mutual funds? In general, with the development of the market these days, an ETF is what I highly recommend. Exchange Traded Fund, it stands for. It's like a mutual fund. You buy a ticker, and it gives you a mini diversified pool within that of those asset classes. So you can buy an ETF for equity, an ETF for bonds, an ETF for alternatives, which I'll define that, read up on it, and then cash. So that you could buy 4 ETFs, exchange traded funds, and it gives you that one trade gives you a diversified within there. So individual stocks are fun. Definitely, if you enjoy it, do it. There is more risk because it's just individual companies.
So this is kind of safer version.
Safer way to do it, and more time efficient. Later on when you really are excited about it, you can get into it. But in general, a diversified approach, the free lunch in the investing world, ETFs are the way to go, in my opinion.
Okay. Yeah, so then I guess you were about to touch on the different account types, but while I was working here last summer, I spent some time on a program that kind of focused on how taxes affected the different account types.
Beautiful.
Such as the IRAs, 529s, and HSAs. But now, since it applies to me more directly, I want to know the difference between when the taxes are applied and what that effect would be.
Yeah. That was it's called the horse race, right? That was a wonderful program. Yeah. So did anything that surprise you when you were doing that project?
I think
the end results?
It was all the same deposit amounts, but it was the outcomes were all so different. Which was just really kind of shocking.
And for you listeners, so she did a great job building this program. So money going in, depending upon the different account type, the only variable was different tax treatments with all of those. It was called a horse race. It was an excellent way to see the impact. And so for you, there's many different account types, and so we move beyond the bank. What do we do? For today, let's stick with 4. Normally, I would just do 3, but do you recall what the highest returning, like the biggest ending balance was? What kind of account was that?
An HSA.
HSA, yeah, the health savings account. The reason that was the case was because that had the best tax favors, beginning, middle, and end. So we're going to talk HSAs just because it was the highest, and then we're going to talk IRAs. There's both Roth and traditional, which is probably going to be the biggest
that's
question
kind
you
of
have.
mainly
So
what I want to.
I'll get there. So bring me back. We'll talk Roth and traditional, and then just as a default, there's just the taxable, the individual account. And there's more, but for today, so the tax treatment, definitely with taxes, it's very important to understand them. You're not going to digest it all right away. It took me years, doing it, but after you do it, it's very helpful to understand and you saw the impact of it. So, in general, as you make money, paying you here at Pebble Valley, you have to pay taxes on that.
Yeah.
And if you just make the money, pay taxes, and spend it all, there's no benefit.
Yeah.
These account types don't help you because you spend it. But if you have some left over and okay, should I put it in an HSA or one of these IRAs or taxable account? So again, back to that first question, how soon do you need the money? If you need the money in a few years to buy a car, do not put them in IRAs because you can't touch them without penalties for a while. Technically a Roth you can, but I'll say that for later. So money you need in a few years, use an individual taxable account. Okay. There's no tax benefit for putting money in there. You got to pay taxes as you earn money, as it grows. And when you sell stuff to buy your car or whatever, you got to pay taxes on capital gains. Yeah. So a taxable account doesn't give you any of these tax benefits, but you can do, it's liquid.
Yeah, and at least it's like growing. Right?
Exactly.
Yeah.
It's definitely growing. And these investing concepts that we talked about earlier apply to all of these. And so you're still doing the same investing concepts for all of them. On the other end of the spectrum, the HSA, it's like, well, Kirk, that was the biggest earner at the end. Why don't I just pile it in there? There's a restriction, and that is you have to use it for medical costs. So it's not going to buy a car, not a qualified medical expense. But the nice thing about there, and then the IRAs, so the difference between these 3 relatively taxable is when you put money into these accounts, do you get to lower your income for taxes, pay less taxes? Yes for an HSA, yes for a traditional IRA, assuming you meet the rules, which I won't get into today, and a Roth you don't. So it's like, well, okay, I'm going to do one of these 2 because I want to lower my taxes. It's like, okay, but hold on. As it grows, these 3, you pay no taxes. So that's good. So they're all 3 running the same horse race. But when it's time to take the money out, again, the HSA, only for medical expenses. Hopefully you don't have many. The traditional IRA, because you didn't pay taxes yet, they're going to get you on the way out.
Okay.
Whereas the Roth, because you did pay taxes, you get to take it out tax-free. So a lot of details here, but so the different account types is, okay, do I want to, it's called, you want to tax the seed or the harvest. And so if you do a traditional, you don't have to pay taxes. And so you're not taxing the seed. You plant it, it grows, you have this great harvest, but then you got to pay tax on that. Whereas a Roth, you have to pay taxes first and put it in, and then it grows. And so that's why the horse race results. And I'll try to throw it. There'll be a graph on the screen here that shows you, and there's a bunch of assumptions, and so you can look at it. But in general, just the magnitude, you can see why we're talking about this. And so that's why I just want to quickly show that why it matters for people, because it is a big difference. So it's like, well, let's get back to the Roth and the traditional. It's like, okay, Kirk, rein it in. What should I do? So in general, a Roth, you don't get any tax benefit now. So you got to pay taxes now. They come to tax-free. Traditional, hey, you get a tax benefit. That's great. But then you got to pay the taxes later. On the way out, So the biggest driver for you is going to be, what is your tax rate now? And what do you expect it to be? No one knows, but expect it. And in general, for younger people like yourself, you're probably going to be in a lower tax bracket. So in general, it makes sense to go Roth. If you're in the 10, 12, even 22 for sure. But if you get up into the 32 and 35 tax bracket, there it's like, that's a pretty high rate. Yeah. Maybe I should take advantage of the traditional, bracket. So that's the key differences is, I don't know if a lot of details there, but that's the, read up on it too. I'll have some links in the blog post that talk about that.
Okay. Yeah.
But again, and same thing, back to your first question about investing, all concepts apply to all those accounts. Other than the time horizon for the taxable account, you might have to invest it a little shorter. But so that's the, I don't know if that helped or made it more confusing.
No, that definitely answered my question.
Yeah, excellent.
And then I have to switch topics a little bit. I might ask questions about like inflation rates, because I know, like, I definitely notice when like my food's going from like $13 to like $18 and stuff like that.
That sucks.
Like I see the inflation, but I don't really know like what I should be doing differently or like how it's affecting like my savings and my like spending and stuff like that.
Yep. Yeah. So great question. So inflation, you probably saw it. So you said 13 to 18 roughly.
Yeah, stuff like that. I feel like $20 like is like the new.
So, talk to your friends. They may be seeing it. Talk to your parents or grandparents who are definitely going to be seeing it. And they'll tell you all about it, right? So that's called inflation. And over time, I guess from your perspective, readers, cost of things go up. That's not a bad thing in and of itself. So as long as your wages are keeping up with it, or your investments are keeping up with it, then yes, inflation stuff is costing more, but hopefully you have wages or securities,
so
stuff that you invest in. Cancels it out.
Yeah.
So now that's not always the case. And so yeah, as you're seeing it relative to say last year, are you being paid more from Pebble Valley than you were last year? And the answer is yes. You have higher wages, but sometimes inflation goes up much, like 13 to 18. That's a pretty big percentage increase. No one's wages are going up that much, and probably no one's investments that are reasonably diversified aren't. And so if it's too high of inflation, that's where people talk about it more and get frustrated with it because they're losing their purchasing power.
That's what I was going to ask about.
Their wages aren't. Have you heard that term, purchasing power?
Yeah,
before?
like I talked about it in my economics class, but I don't really know like what it really entails, I guess.
Yeah, so let's, with your 13 versus 18 example, the purchasing power, let's say that you wanted to buy a burrito next year, and so you put your $13 in the bank, and then you're going to take it out in a year and go buy a burrito. You put in $13, it grows to say $16 because you earn some interest on it, and you take it out, and then you go to buy your burrito, and it's $18.
Yeah.
So that purchasing power, you just lost $2. Your earnings didn't keep up with it. So purchasing power from an investment perspective is, are your investments growing at least as large
as inflation?
Then you're keeping your same dollar you put in X years ago is keeping up. The power it has to buy something can buy similar things.
Yeah, I see.
Yeah, and then same thing with wages too, but that's more real wages. It's called.
Yeah, you can't really.
Growing up. So that's the purchasing power concept, and definitely from again, stuff you need near term, park in the bank. In general terms, so you'd ask like, okay, how should it impact your investing?
Yeah, so does it more affect like the money that's sitting in my savings account, I guess?
Yep. Yeah, you will definitely find savings accounts likely won't keep up with inflation, especially runaway inflation. Not much will, but even just general inflation, savings accounts are always going to not quite keep up with it. But the bigger importance there is it doesn't lose money. So you need it near term. So it's now $18, but I want to buy that burrito tomorrow. You don't want to be invested in the market that just dropped,
and then you can't even
20%. Yeah. Then you have to buy a glass of water.
Yeah.
You buy a glass of water. So yeah, it impacts the the savings amount is where you're going to lose some of that purchasing power. And that's an example where a lot of people are like, hey, I'm just going to stay in cash. It's nice and safe. Over the long term, you don't want to do that because you're going to definitely lose your purchasing power. And so, let's say you're an aggressive investor and I'm a conservative one. Let's say we're the same age. I look much younger than 60 years old right now. So you put it in a diversified portfolio. I put it in a bank, and mine grows 3%, but at least it was nice and safe. Or maybe it probably grows 1% if it's in a bank, 3% in money market. Whereas yours, more volatile, but it kept up with inflation in the long term.
Yeah.
So that's where with inflation, it's good that you see it now and be aware that you got to make sure your investments are keeping up, and your wages. If your wages aren't, then it's up to you to push on your boss and say, hey, inflation is chewing me up here. If you're in a high demand industry, they're going to, supply and demand will generally take care of that. The wages there. So so that's I'm trying to think if there's anything else on.
No, that definitely answered my question.
The concept, the purchasing power then make a little sense.
Yes, for sure.
Excellent.
And so then last episode we kind of touched a little bit on debt, like especially with credit cards. But I know it comes in a lot of like different forms, and I know that I feel like there's a lot of different kinds of debt, especially like good and bad debt. So I was wondering kind of like what that would look like, I guess.
Yeah, so definitely good and bad debt. It's a good distinction. I mean, first of all, I guess stepping back, what is debt? And so, debt is you're asking somebody else to give you some money so you can go buy something because you don't have the money to buy it. That sounds pretty cool, right?
Yeah.
But debt is, that person's going to expect to be paid back, and not only paid back, but give you a little extra something, interest it's called, for my trouble, because that person wasn't able to go and buy something.
Yeah.
So you have to give them more money to compensate for that. So that's what debt is. And so the good debt would be, and that's a good distinction to draw it from. I view good debt as, okay, the thing you're buying, and one, you have to make sure you have the ability to pay it back. So this isn't just free money.
Yeah.
You're buying it, but you got to slowly pay them back over time. So good debt would be you're buying something that's going to either keep its value or grow in value. So like something for you, student loans, for example. So that's you're investing in your education, your future earning power. So that's something that definitely is going to be growing. So that's a good investment.
Yeah, and then I'd get like my returns.
Yeah, you'll get it. Come back to Pebble Valley or a different company. You're going to get paid more money, and then you can pay it back. You didn't have the money now. Later on, you're buying a house. That's good debt. You got to take on debt to buy the house. The bad debt would be if you're just using credit card to consume. Like, hey, I don't have enough money to do this, but I really want that thing. I'm going to put it on my credit card and go buy it. It's like, well, that's great, but you've just consumed it. It's gone, and you still got to pay back that money. So. And again, last episode we talked about different kinds of debt will have different interest rates as well. If you have the good debt, the bank or the person lending it to you knows that, okay, you're investing it in your career, student loans, or your house. That's going to have a good return on their investment, so they're not going to charge you as much. Whereas credit cards, they have no idea what you're going to spend it on.
Yeah.
So they're going to charge you a lot more for that convenience. And so, kind of back to that inflation or investing, the higher the interest rates, your debt is going to be even higher than that. So, want to be careful about what the cost of that borrowing is. And then I guess the middle road too. So, credit cards too. It's not all bad. Sometimes it's just convenience. If you're going to Chipotle to get your burrito, if you got your debit card, again, that's probably the best way to go. But just a convenient transaction as long as you have the money to pay that monthly statement when it comes due.
Okay.
And the middle road, I guess, car loans. Some people say, well, Kirk, that's good debt, even though it's a depreciating asset. And that's true as long as you don't overbuy a car because you have debt. So, okay, you're taking a loan because you don't have the money now. You want to make sure that you have enough money in your budget to pay back the car loan. Don't stretch it out beyond 5 years because some people will, hey, I want to buy a really fancy car, get a 10-year car loan. It's like, oh, not a good idea because that car depreciates before that. But so those are the forms of debt. I'm trying to think if there's anything else on there. Yeah, that probably.
I feel like that covers on the main topics. Yeah.
Go with the debit card or credit card for your first year?
I think a debit card. Yeah.
Yeah, I think that's a good call, just to get that discipline down and figure out what's going on.
My budgeting and stuff like that down. Yeah. We'll see.
Excellent.
See where to go from there.
Yeah. So did you like your first college assignment here? Go read up on some of these concepts and. Yeah. It's obviously, great resources at your fingertips. We've been using. I here this summer doing some
really
things.
Cool.
Yeah,
powerful.
So very powerful, but it's a tool, not a replacement. So I guess my little soapbox speech for the listeners out there and for yourself is, it's a great tool, so use it. But there was a line I cut it out a long time ago, and Confucius, I don't even know how far back he would go, but many years. So his line is, I see and I forget. No, I'm sorry. I hear and I forget. I see and I remember. I do and I understand. So even though you've got AI, the quick answer at your fingertips, that's kind of a C. You might kind of remember, but you don't fully understand until you do. So get out your spreadsheet or prompting your AI, but make sure you know what the prompts are doing and do the doing. Read up on some of these concepts and go a long way.
Yeah,
so
definitely.
Yeah, I'm very impressed. Again, great questions you had at such a young age.
You.
And you're on your path for a great future.
Hopefully.
So we'll enjoy the run up to Madison.
Yeah, I'm excited.
Yeah, exciting times ahead for sure.
Yes.
So and those listeners, check this out. Thank you. Go back and check out the other one. If you're off to college soon, good luck and have fun. If you're not off to college but want to be, keep on dreaming, and we can go back and do some more, right? And go visit. And what are you going to do in college?
Yes.
Call your mother.
Yes.
You have 5 minutes. All right. Well, that's a wrap on this episode number 2 of the Finance Fundamentals series. Thanks for joining us.
Thanks for listening.
All right. Take care. Thank you for listening to this episode of the Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.